Good morning, everyone. Welcome to this special talk today of the Quantitative History Webinar series. So today we have Dr. Chenzi Xu from Stanford University. So she is an assistant professor of finance with research interest in finance, economic history, and trade. So prior to her joining Stanford University last year, she was a postdoctoral fellow at Dartmouth College, working on trade issues. So she got her PhD in economics from Harvard University. So today, her topic or the title for her paper is Monetizing the Economy, National Banks and Local Economic Development. To join us today, we have my two colleagues, Professor Zhichen Ma, who will moderate the discussion and the Q&A part of today's webinar. And then also Professor Chen Lin, who is a professor of finance at the University of Hong Kong. So Professor Lin will be giving a 10-minute to 15-minute commentary on the paper. So just quickly, the format of the event for today is that Dr. Xu will talk for about an hour, and then during her talk, you can post your questions, comments in the Q&A box, and then after that, we will have Professor Lin doing the discussion, followed by the Q&A part of today's talk. So now let me turn it to Professor Xu.
Thank you so much, Professor Chen, for that really nice introduction. And thank you, Professor Ma and Professor Lin, for inviting me and for hosting such a nice seminar series. I'm really excited to be here. So let me share my screen. So yes, very excited to be here and to be giving this talk to such a wide and varied audience as well. So this paper is joint with a colleague of mine from graduate school, He Yang, who is now at Amazon. And in this paper, we're broadly motivated by two areas of research. So the first is one that emphasizes the extent to which economic activity doesn't exist in autarky, and that the trade relationships that exist between economies is really important even within countries. So for instance, there's a lot of work showing how physical infrastructure investments improve market integration and development for both the US in various historical periods, as well as in developing countries today. And so while this work is focused on the importance of these reductions in physical trade costs, there's a lot of work, especially by Anderson van Winkoop, that has highlighted how physical trade costs are only a small component of overall trade costs. And in fact, institutional barriers or informational frictions contribute much more to the overall frictions associated with long distance trade. So related to this idea that non-physical trade barriers are a really important source of the disparities among economies, I've done some work along with some others looking at the role of financial institutions in lowering these trade costs. And in particular, this work has really focused on the direct financing channel, which is using the importance of the cost of credit or the supply of credit to estimate the impact on volumes of trade. But in this paper, we're trying to take a broader view of the role of finance and think about an additional indirect channel that financial intermediaries can play. And in particular, thinking about the role that they have in providing liquidity. So the theoretical background that we're going to lean very heavily on is the idea introduced by Gorton Panacci, where they show that banks are particularly well positioned to create liabilities that are going to be riskless because they are able to bundle their assets together so that the stream of payments for their liabilities are constant regardless of the state of the world. And so the fact that there is this guaranteed payout stream, regardless of the state of the world, means that the price of these liabilities is not going to fluctuate, which creates liquidity and makes them very useful as a transactions medium. Okay. And so the importance of the transactions medium created by these financial intermediaries is going to be how we think about them impacting trade costs. So in particular, they're going to be lowering the trade costs associated with payments, which broadly speaking is going to increase the market access for any local economy, which is essentially the overall trade costs of many different markets being able to reach a particular market in order to trade with it. So in this paper, we're going to use the National Banking Act of 1864 in the United States as a historical laboratory to examine the question of how much the bank-created liquidity can, in addition to direct credit, impact trade-related economic activity. Now, in order to answer this question, we have a couple of empirical challenges. The first is one that people are very familiar with thinking about with respect to financial markets, which is simply just that financial markets aren't randomly allocated across space. So banks don't locate randomly. They're going to figure out what makes the most sense in terms of their growth opportunities. And second, which is a slightly more subtle point, is that when we're trying to back out the importance of non-credit channels, these are precisely channels that are quite difficult to observe because they're not balance sheet items. So we can't measure them in the standard ways. So in this paper, we're going to try to overcome these challenges by leveraging the institutional context of the National Banking Act itself. And in particular, we're going to lean on two features. The first is that there is going to be exogenous variation in the likelihood of getting access to a national bank, which is going to come from regulatory capital requirements based on the town population that these banks are located in. And so that provides a discontinuity that essentially is going to act as an instrument for us. The second is that we're going to use the specific institutional differences between national banks in the way that they were created and regulated to back out the change in terms of the economic mechanism that they're able to provide to these local economies. So just thinking about the how they're structured differently relative to the banks that existed beforehand. So in a bit more detail, broadly speaking, the National Banking Act created a new class of banks that were first better capitalized, second, issued a uniform currency as their liabilities, and third, specialized in lending to non-agricultural sector with shorter term credit. So the way we use these three institutional details is the better capitalization provides the source of identification. So this is precisely those regulatory capital requirements that I mentioned earlier. Once we use that, we can essentially distinguish between places that are more likely to get a national bank versus less likely to get a national bank, and therefore places that are overall treated with this form of financial development versus those that aren't. Once we're comparing between places that are treated and not, we then want to think about how to back out what impact they have. And so first, all treated places, all these places that get a national bank are going to have access to a new uniform currency. And so this change in the type of financial development is the indirect channel that where we want to think about the liability side related changes to bank services and how that impacts economic activity. But even within these places that are treated, there are additional regulations in terms of how much the national banks can extend their asset side to the different sectors. And so what this means is that we can then try to rule out or at least separate the industries that would be further impacted by the direct channel of having direct access to credit from these banks. Okay. So now I'm going to go over each of these institutional details and more with a lot more context and describe exactly what we're doing with each of them. So first, on the role of the regulatory capital requirements, these are going to be our instrument, where, as I was saying, it's based on the population of the town that the bank is going to be located in, as recorded by the most recent decennial census. Okay, and the motivation from the regulatory perspective for having these regulatory capital requirements was that when they established national banks, they were very concerned that these banks may not be financially stable. And so their philosophy for ensuring that these banks were stable and wouldn't be sort of sources of risk in the financial system was that they needed to be sufficiently capitalized, i.e. have sufficient equity in modern day language. And they felt that as a rule of thumb, the size of or the degree of equity capitalization should be tied to the amount of economic activity in the area that these banks were serving, which makes a lot of sense. The way they did it was with these very stark requirements, however, where if you look, you see that towns below the 6K cutoff have a 50K capital requirement, whereas the ones above have a doubling of that requirement. So around the discontinuity, the per capita equity that needs to be raised to create a bank is going to double. Now, this requirement tied to the town population is actually very binding for several reasons. So, we don't think that it's a big concern that you might have some angel investors from far away where, local economies are able to leverage the capital or the equity from, say, New York or Chicago or other places where you would think this population constraint wouldn't matter. And there are three particular reasons for why this constraint is probably going to bind. So first, we're in a world where all national banks aren't allowed to branch. So they're all unit banks. So they literally only have one physical location and had to operate in that one physical location. In addition, the directors that were raising the equity for these banks had both a residency and an investment requirement. So these directors had to live in the local area and they had to invest a minimum amount. So you couldn't just have a guy who lived in the area, who was nominally a director, but not actually be invested. And finally, this 50K capital requirement is actually an incredibly big number. It was over 140 times the annual manufacturing wage. So this is just to give you a sense of the size of these banks and the extent to which it probably would have been quite difficult to overcome this doubling of the population requirement when you're near that threshold. And this is particularly relevant compared to the state banks that existed before these national banks, which for the most part either had no capital requirements or very low nominal sorts of capital requirements. So the way we then use these requirements is that we construct a sample where we're going to compare a set of towns that look very similar, except for the fact that some are going to grow to cross the threshold and some aren't. So what we do is we look at the 1870 census. So as of, we're looking 4 or 5 years after the Civil War, so things have calmed down a little bit. And we're going to compare all cities and towns that have a population of fewer than 6,000 people as of 1870. And this is important because it means that all of these towns are similar in the pre-period in that they face the same low capital requirement. So they all have the same opportunity in terms of creating a national bank, but they all don't have a national bank. So as of 1875, none of them has a national bank. And so what this means is we're going to be focusing on the change, the impact of the first national bank entry. We choose 1875 because there's actually many amendments to the National Banking Act that happened in the early part of the 1870s. They're fairly minor, but they do change the relative cost of creating a national bank. And so 1874 was the last such amendment. So we check that these places still haven't made one as of 1875. We can make this requirement stretch all the way out to 1879, for instance, and that doesn't really change the results. The next requirement that we require is that as of 1880, so the next decennial census, the population is bound between 4 and 8K. So this restricts the amount to which these towns could have grown or shrunk to a fairly small bandwidth. And this is to keep these towns comparable. Now, because we're basically by construction requiring that these towns look very similar, on all observables, I'll show you these places that are just below versus just above actually look exactly the same. But the idea is that by doing this in terms of the observables, we're also helping to assuage the concerns that there are unobservables that may have mattered. Okay, so what we do then is we construct our instrument for gaining a national bank as the towns that are below the population threshold. So those towns that cross the threshold, the town Bs in this example, are now going to face exogenously higher entry costs. And in addition, we're going to control for the change in population between 1870 and 1880 so that we're controlling for the growth path of these economies that we observe. So once we've controlled for the fact that they are growing at different rates and we've constrained things to being in a very narrow bandwidth, we're essentially left with the identifying assumption that what we need in this diff and diff discontinuity setting is that there's no concurrent shock to the set of towns that are below the 6K threshold, the set of towns in 1880. So as an example of the type of violation to the exclusion restriction that the identifying assumption that we might be thinking about is, for instance, if there are other legislation about, say, the taxes that you have to pay once you're over 6K versus under 6K, or some other form of developmentally related regulations, then we would be really concerned that it's something about this other threshold that's really binding. What we so we do some placebo checks and try to convince you that the first stage is actually pretty legitimate. In order to do the construct the sample for this for these requirements, though, we actually have to go back to the original census publications, because we're looking at what they call the minor civil divisions within counties. So we have to look within county and look at these specific towns in order to pick out the populations. So we actually hand code all the populations in these different decades at all these different subunit towns in order to precisely pinpoint the locations that would have been affected by this threshold. That gives us the population data. In order to figure out where the national banks are, we turn to the annual call reports, which were collected by the OCC, the Office of the Comptroller of the Currency, which was the regulatory body that oversaw national banks. And with that data, we use the name and the town location of the bank as recorded by the OCC in order to match across locations to determine whether in 1875 these banks were located in a certain town or not. You can see from this slide that there's a lot of balance sheet information in these annual reports. And we actually have collected all of the annual reports data as well. So we can look at the size of the lending, we can look at the different components of the balance sheets and sort of try to dig in a little bit more as to what these banks are doing. So the sample of towns that we have are in these blue dots. So this is, these are all the places that had subunits that were within that narrow bandwidth in 1880, but were quite small in 1870. And so for full transparency, this map shows you the places that crossed the threshold in blue, the places that were below the threshold in blue, and the places that crossed the threshold in orange. And once these, and so with these data, we then estimate the first stage, where essentially we're asking whether the we're regressing whether a town I in state S has a national bank as of a decade later, so by the mid 1880s, by 1885, and we're regressing that on whether the town had a population that was below the 6,000 cutoff as of the 1880 census, constrained to these smaller places where we do control for the population growth, and we can control for a lot of observable characteristics of these different towns and locations. And the bottom line is that we come up with a fairly strong first stage. So the way to interpret this is that being below the population threshold, i.e. just being a bit smaller than 6K, meant that you had a 30 percentage point higher likelihood of gaining access to a national bank in the following 10 years. So now in what we also do is we have some first stage falsification tests. So we're essentially asking, is there something really special about the 6K cutoff? So we weren't able to find any other regulation or anything that mattered at the 6K cutoff, but we're also looking at whether maybe this is just reflecting something about size. Maybe the fact that smaller places were more likely to gain a national bank is purely coming from the fact that they're smaller in the population distribution as opposed to larger. And so if that were the case, you would expect to see a very different pattern of coefficients. And in particular, probably that the likelihood of gaining a national banks should increase in this direction. But we don't actually see that. We see that there's really no effect except right at this cutoff. So I think this helps to convince us that there is something really important about this regulatory capital requirement. This is just another balance table to show you how balanced these places are. Okay, so going back to this overview of the three types of institutional details that we're really going to highlight, the first that they have the better capitalized banks is this our source of identification. And now I'm going to talk about the second, which is this uniform currency. So the thing that I really want to convey is that the banknotes that existed before national banks were created, which were the ones printed by state banks, were incredibly illiquid. So the money supply was primarily created by these state-regulated banks, and there were many, many frictions. So the first is that they weren't actually legal tender, which means that nobody was legally required to accept them as a form of payment. So the fact that they were used was just basically out of the fact that there was some reputational element to these notes, especially in local areas. So since they weren't legal tender, the only place you could actually get something real from them, which is to say gold or silver, whatever backing they claim to have, was by redeeming them at the originating bank, which means that there were clear physical transportation costs associated with taking a banknote that you can't convert into real goods of any sort into something that you could convert into real goods. Second, there was a lot of uncertainty about the value of these notes because of counter frictions and bank solvency risks. So, counterfeiting and bank solvency risks. So these notes, because they were printed by any bank who wanted to print notes, could look like anything that they wanted them to look like. As you can see, they're very irregularly printed. They have no uniform design. They have no uniform denomination. They could really say anything, be printed on anything. So if you were to receive one of these notes, it was incredibly difficult to tell if it was a real note or a counterfeit note. In addition, there's the risk that the bank that has issued this note, say the Bank of Boston, while it's a real bank and the note is real, by the time you get around to redeeming it at that bank, it's gone. It's closed. So this solvency risk was something that you could really observe in the data. Okay, so given all of these frictions, what you actually see in the in the contemporary record is that it was incredibly difficult to transact across local borders, across local economies. It was incredibly difficult to travel and to take currency from one place into another. And so this is, a really amusing anecdote. If you think about it, it's actually a huge amount of frictions where this guy is talking about, traveling the length of half a day's drive in today's world. He starts with Virginia money. He has to transact basically 4 different times he has to convert his currency at least 4 or 5 different times in order to buy food and lodging. And at the end of the day, he isn't able to even, stay at a hotel because his all his notes that he has is not deemed legitimate. So this friction was very easy to see empirically when we look at the data on the note discounts. So this is data that Gary Gorton worked with, and essentially what this is these plots are showing is the discounts that you would have to take on currency from other states in Philadelphia. So if you were in Philadelphia and you tried to spend a note that came from Mississippi in the 1850s, you would have to take a 60 to 80% discount on that note. So $100 would turn into $40. This, as you can tell from these graphs, these are both varying over time and across space. This very stark change in what was going on with Illinois notes actually is a pretty interesting story about the importance of bank solvency risk. So so in the late 1840s and early 1850s, there was a lot of concern that the banks in Chicago were going to be insolvent because they had invested in a canal that had gone poorly. And so you see that this is immediately reflected in the discounts that Illinois notes took relative to the pre-period. Okay. So given that these huge frictions, the Congress actually made it one of their main goals to create this uniform currency. And so the way John Sherman of Ohio puts it is that the requirement would be that the currency is uniform so that a bank bill issued in the state of Maine will be current in California. And one way to think about this is they were basically saying we need to have some sort of monetary union in this republic where everything is completely fragmented. And so what I'm showing you in this map is actually the distribution of national banks by 1875. So this is giving you a sense of how widespread national banks became within less than 10 years after, within 10 years of the National Banking Act passing. Okay, so with the introduction of these national banks, you also had the bank notes. And the way they made sure that these notes were liquid was that they required that they were backed 110% in federal government bonds. And this essentially ensured that there was zero default risk on these notes. There's actually a huge amount of legislation talking about what would happen to these banks should they become insolvent, and the system of receivership and bankruptcy, of insolvency procedures was designed to protect the note holders. So in the same way that today financial banks are designed to have insurance for depositors, historically in this period, people were less worried about depositors losing their assets, and they were much more worried about note holders losing the value of their notes. So by requiring this backing in federal government bonds, which is essentially actually what the Federal Reserve does today, just in a much more systematic way, we don't worry that these notes will default. The other important regulation was that any banknote issued by a national bank would be redeemable at any other national bank. So they eliminated the friction of requiring that a note return to its origination. So you could have a note in Maine and redeem it for gold in California. It didn't have to go all the way back to Maine. So this essentially means that the long distance trade costs associated with using different payments was going to be significantly reduced. So the liquidity that's generated from these national banks come from both the supply of these better quality assets. So literally the fact that the money supply in these local economies increased from the printing of these notes, as well as the network effects that's compounding the usability of these notes beyond just the local town where they're circulating. Okay, so the uniform currency is the source of this indirect channel. The final regulatory element of these national banks was that they had a very strong non-agricultural emphasis. And this is because there was a strong belief that the riskiest lending in the economy came from holding real estate or anything under mortgage, which essentially meant that farmers whose wealth was all kept in physical land capital, weren't able to pledge any collateral that was going to be accepted by national banks in order to fund any of their borrowing. Okay, so even though the letter of the law is that they're not allowed to have real estate the ultimate interpretation or the ultimate bite was that this meant that the agricultural sector didn't get lending from these national banks. And in fact, some work has been documenting how there's essentially the sectoral split between national banks that catered much more to lending to the manufacturing sector and the state banks that ultimately catered much more to lending to the agricultural sector. Okay, so with these institutional details in place, the way we interpret the real effects of having a national bank is that they improve the local liquidity, which then raises market access. And this comes from both the direct supply effect of increasing the local currency supply, and from the network effect, which is compounded by all the other national banks in the country. And we think that this change in the market access is going to be particularly relevant for long distance transactions. So essentially, the relative trade costs are going to decline much more for places that previously relied on much costlier means of transactions than for local economic activity that doesn't have any trade component, which could have always used these local notes that had existed before. And so, broadly speaking, this class of models where we're thinking about the changes to market access generates some very clear predictions. And this is something you'll get from most classes that have these sorts of reductions in trade costs. So the first is that the traded sector expands, and this is very intuitive, and this is coming from both the lower trade costs of inputs for creating things that are traded, as well as selling the things that are being manufactured or produced. It's also going to increase product variety because lower trade costs are a positive agglomeration force. And with positive agglomeration forces come this competitive edge of distinguishing your products and wanting to, and essentially appealing to the love for a variety that we tend to build into utility functions. Okay, so with these predictions in mind, I'm then going to turn to the outcomes that we look at, where we're going to just separate them by the sectors, where we'll focus on agriculture and then the labor market, and then finally manufacturing and innovation, where essentially in each of these sectors, we're trying to have some proxies for thinking about the traded versus non-traded sectors. Okay. So I'm going to show a bunch of regressions that have this style, and the way to read these regression tables is the left-hand side is the change in an outcome in a given town I in a given state S, regressed on either the reduced form of being below the cutoff, or the OLS of having a national bank, or the instrumented version of having a national bank coming from this being in the lower cutoff. And we can include a bunch of observable controls, and we'll always have state fixed effects, so we're not comparing towns in very different parts of the country. What this first table is looking at is total agricultural production per capita in the change in the decade from 1880 to 1890. And what it's showing is that there is essentially no change in agricultural production. And this, this is very clear, no result. And we think that this is fairly consistent with the fact that there was very limited lending by national banks to the agricultural sector. If we further decompose the changes in the agricultural production, we see that there's no change in the land values and the fixtures. So basically the physical infrastructure values in the agricultural sector. But what we find is that there's a significant shift in the composition of goods produced. So what we do is we take all the products that are listed in the Census of Agriculture, and we divide them into the ones that are traded because these are the products on the Chicago Board of Trade. So these are very deep commodity markets. And we compare them to the products that were relatively untraded. So these are goods that aren't listed in the CBOT and are also goods that for the most part were produced into things that were consumed more locally. And what we find is that there's a very significant shift where there's a reduction in the non-traded share by about 10 percentage points. So given after the introduction of national banks, local economies produced much more goods that were traded as opposed to non-traded. And so this slide just summarizes the coefficients that I showed you just now, which is that we see very little in terms of production or land value, but we see this shift away from non-traded goods. So this is, these are normalized coefficients. So, in terms of the normalization, we see a 2 standard deviation decrease in the share of non-traded goods in the places that got a national bank. Now, we're going to turn to the labor market effects. And here we collect a data set where we use these town level business directories that allow us to see for each type of profession, how many people are, or how many businesses or listings there are for that profession in each town across the country. And so we create a few proxies for trade-related professions versus non-trade related professions. And so the clearest trade-related profession are commercial merchants. So commercial merchants are literally just buyers and sellers. They're not producers, they're middlemen. And what we find is that places that gained a national bank have a large increase in essentially these middlemen who are just acting as who are just facilitating transactions. We can also turn to the census of population data to look for a similar profession, which is listed as the buyers and shippers occupation. These are essentially the same occupation. And in the county level census of population, we find a very similar result, that we have this large increase in the employment of people in this traded sector. We use a number of placebos, either in higher skilled professions or lower skilled professions, to sort of proxy for ways in which these places could just be growing more generally. And we find that across other types of professions, there's really no effect of gaining a national bank. Okay, so we have doctors, we have architects, we also have a number of other types of more low-skilled labor in these results. So far, I've shown that there's a shift toward the traded sector in agriculture. There's also an increase in the people who are working in the traded sector. In the manufacturing sector, we do see a strong increase in overall manufacturing production. And this is not coming from a change in manufacturing capital, but rather a change in inputs. Okay, so putting this together, what we're seeing is that the manufacturing sector is growing, but it's not growing because long-term physical capital is growing, but it seems that these factories are essentially able to source more inputs and channeling them into more outputs. Okay, so this is the part of the paper where we're essentially allowing for the fact that the manufacturing sector is the one that most directly benefited from these national banks. These, the manufacturing sector were larger firms. They were the firms that were going to have accounts with national banks as opposed to with state banks. They were going to benefit from short-term credit that can look very much like trade financing in terms of facilitating payments frictions in that period of shipment between when goods are ordered and when they're delivered and paid for. And so all of those components of what the national banks are doing, we're allowing for that in these manufacturing sector results. So we think that these manufacturing sector results are really combining both the indirect effect of the currency, the local currency, as well as the direct effect of having these additional financing channels that they had access to now with these bigger, better capitalized banks. The final empirical result that I'm going to show is our measure for basically product variety. So we use the patents data, the historical USPTO patents data that we link geographically to these towns. And we look at the growth rate of innovation in terms of the number of patents as a proxy for product variety. These patents were mostly in the manufactured sector. They were mostly for physical products. So we think that they're a reasonable proxy for sort of the development of of different product varieties. And what we see is also that these places that gained a national bank had much larger innovation, i.e. we think reflecting the agglomeration forces. And this is and it's important to remember that the way to think about this, especially in the reduced form, is that we're looking at smaller places. So it's just across the board, these smaller places are the ones that are growing more. Okay, so just as a summary of what we saw just now, we see this increase in outputs and varieties for manufacturing, which we think is mostly coming from being able to source more inputs. Okay, so I think this is one of my last slides. In terms of outcomes, we were looking at 3 different sectors. And we think that there's pretty compelling evidence that the impact of having access to this national banks is changing the composition of economic activity to be more traded sector heavy. This is most noticeable in the agriculture sector and in the labor market, but you can also see this in the way the manufacturing sector grew and in the degree of product variety and product innovation. Okay, so I'm ending a little bit early, but I hope that means we have a bit more time for questions and discussion. So this is a paper where we're really trying to explore the extent to which a bank reform can change both the direct credit services of local banks as well as the indirect liquidity services, and look at how that impacted real economic activity. And we think that this institutional context is really nice for providing an identification strategy that overcomes a lot of the standard challenges when dealing with where banks are located and how to link financial development to real outcomes. So thanks a lot for your time and attention, and I really look forward to your questions.
So thank you so much, Chenzi. And also thank you for giving us more time for discussion, right? So, well, in next, let's invite Professor Chen Lin, who is the professor and the chair of finance in Hong Kong University, to discuss your paper for maybe 15 minutes. Professor Lin.
Okay, so first I would like to thank Chenzi for this wonderful presentation, and also I think it's a very interesting paper. I personally learned a lot from the paper, especially on this the liquidity of the banknotes. I was not aware of this the very high discount of the banknotes in other places, so this is something new to me. So I myself, I have done some work in this finance and economic development. So I certainly love this topic. So I think the presentation is crystal clear, and so this is all good, you know. So, but as a discussion, I have to raise something, right? Because otherwise I could have just stopped there. So I was thinking about first of all, some big picture stuff. For example, like in your studies, you know, sorry, I didn't prepare the PPT, so but I put down some notes. I just so in your story, I think it's very interesting because most of the papers in finance economic development literature look at the direct credit allocation effect, right? So people are thinking about access to bank credit, you know, so it could be short-term credit or long-term credit, but they're all the direct credit assets effect. But you are talking about an effect related to you know, possibly a trade finance effect. You know, at least, you know, based on my own understanding, is a trade finance channel. So, but actually, the banks plays a very important role in trade finance. In most cases, this is related to we also call it a kind of accounts receivable finance, which means how to collect, you know, how to make sure, for example, the buyer will pay, or how to collect those payments, right? So if you look at it nowadays, when we talk about trade finance, there are several very important tools we can use. The first one will be the letters of credit, right? So the bank will make sure that once certain criteria has been met, they will give the payments, right? So as a seller, you don't worry about this the late payment or no payment issue. So letter of credit is one. The second one is called the factoring. And so basically, this basically the bank or other financial institution will buy all this accounts receivable with a discount. Now, when this factoring is related to the international trade content, this is something people also call it forfeiting, right? So this is when you talk about the exporters and the accounts receivable of like exporter. The fourth important tool we use is called supply chain finance. And in many cases, this is also called the reverse factor. Okay, now this becomes very popular in recent years. The key companies collaborate with the banks, and the banks will make payment to their clients, the suppliers, and then later on the key company will pay back to the bank. So because your paper actually focused on this trade finance issues, I was wondering that whether it is possible to provide any kind of related evidence about it, like when this national bank was established and when this the banknotes were widely accepted across you know, national bank in different regions, whether this type of financing arrangements associated with the trade finance will become more popular. Now, I think if you can prove this, this will be certainly a very big plus to the paper, because I think that the most challenging part for this paper is still that how to disentangle the direct credit channel to this kind of a trade finance channel, right? So I understand you've done a lot of things, but you know, if I'm, for example, if I'm the reader or I'm a potential reviewer, I would love to see if there's any evidence on this. So, and then this will also tells us something that, look, because of this national banks, all this financial instrument we are talking about today becomes possible, right? So because the liquidity issue has been solved. You know. So this will be the first suggestion I try to make. The second one, also related to this one, I noticed that one of the most related paper is the paper published by Fulford in 2015, IEStat, right? Which use a similar setting. I didn't read the paper in detail, but I look at the introduction and the abstract. You know, they basically they also find that, you know, so this gaining access to this national bank increased the production by production per capita per person by maybe 10%, And also another thing they find is that they also find this national bank in rural areas improve actually the agriculture production over manufacturing. So these counties becomes more kind of agriculture centric, than before. So now I understand you use different sample and you have a more granular sample, so the empirical result may not be exactly the same, but still, I mean, I'm thinking about the incremental contribution of your paper to that paper. So that's why this is something that related to my first point. If you can show some direct evidence that this is more or less a trade finance channel instead of the credit channel, that would be good. And also related to this, I'm a little bit unsure that whether you really want to incorporate the manufacturing result into your paper, because for the manufacturing, especially in the end, when you talk about innovation, we know that it's difficult to say innovation is only driven by trade finance, right? So in most cases, like innovation is long-term kind of process with high uncertainty. So that must be associated with some long-term finance. So I understand that adding those two sections make your paper richer, but in my opinion, that also makes your paper more difficult to kind of differentiate your paper from Fufo's paper. You mentioned very clearly that the agriculture sector doesn't have this access to bank credit. If this is true, actually focusing on agriculture can help you differentiate from Fufo's paper and to pinpoint another important channel. So that's another suggestion. Now, also related to, because of the Fufo paper, I was thinking about, look, if this agriculture company has no access to credit, how come in their paper they also find they have kind of increased the production and also becomes more agriculture centric? So I was thinking, in your paper you said you mentioned very clearly because the land cannot be used as a collateral, so that's why these guys don't have access to finance. Now, first, it would be great if you can kind of prove this, to show either some document or some policy, so not just claiming. In addition to that is that now agriculture company, they might also have their, for some agriculture machines. Also, as you mentioned, if they produce traded crops, these traded crops could be, important for some commodity, right? So whether these things can be used as collateral, like if you produce 100 tons of wheat, whether this wheat can be used as collateral, I don't know, So now, if this is the case, now then this also help explain the result. Now, because this company want to get access to finance, so they want to produce some kind of a widely traded commodity, so they can use this to get access to the bank assets, and then this becomes another story. So I think it's important to at least to show more kind of institutional details along this point, say whether those things could be collateral or whether this agriculture firm really has no access to bank credit. So this is, I think this is also one of the key assumption or foundation of your paper. Now, related to this, I have another point. That is, look, you have a very granular level of data, which is fantastic. We all love that. But sometimes this also raises another layer of questions or concerns that, for example, you use town level of data. Then people might say, look, if in your town there's no national bank, but in neighborhood town there's one national bank, can I simply kind of we are not talking about the state border, right? There's no border. I just go to the other town, and then I will ask the bank to provide some kind of a banking services. It could be trade finance, it could be credit assets. So would that be possible? If that is possible, then that's raised some questions. And why would you be able to find such strong effect? Right? Because people can move. So, and cross the town is not a very big cost for them. So that's something you probably need to think about it. So two other questions is one is you show another kind of an important jump around the 50,000 population, right? So this the capital requirement of the bank increased dramatically around that threshold. Would that be possible for you to also use that threshold to build up identification strategy? So I understand maybe maybe the observation is not big around that threshold, but that's another suggestion. And also, I think because in principle, I view this empirical strategy as a fuzzy RD type of strategy. And so I would love to see more validity tests showing the, for example, density function of the tongue around the thresholds, and whether there's any jump in other characteristic. So the typical way we do this RD or fuzzy RD type of analysis. The final comments is related to this the analysis that you mentioned in the paper that you used the 1880 populations to calculate to construct the ID variable, right? So and you provide some suggestion about it, but again, this might raise some concern because the MBA was passed in 1864, so which means this was 16 years before the population you use. And we know that in those times, population itself could be a very good measure of economic development. Because so you have this MBA passed, the National Banking Act passed 16 years before that. So the population itself could be a consequence of this the National Bank Act. So that's a concern. So now I thought of a very ad hoc story. So which I know this might not be very realistic, but in the review process, somebody might actually say this. For example, the stories like this, you say, look, the population-wise is relatively small, but that means that you have less local consumptions, okay, of the agriculture products. So that's why you like to produce more traded crop, because the local consumption is small, and so. And because the National Bank noticed that, and they think, oh, look, this is a business we can do, because we can, the banknotes will be widely accepted across the national banks. So then they decide to establish branches in the area. So there's a kind of again, there's a typical ingenuity story we're talking about, but I mean, so. You can think about it, how to further kind of strengthen your empirical strategy, or at least adding some robustness tests to showing that, look, if I use early population as the threshold to construct the ID, the identity the variable, it wouldn't affect the result, or maybe adding more kind of a distance variable or the polynomial, whatever, to further help alleviate this concern. So, but all in all, I mean, it's wonderful paper. I mean, as a discussion, I have to raise some comments, which some might be related, some might be because of my oversight of the paper. So, but I enjoy reading the paper, and I hope very much that you can visit in person in the future, so that we have a strong group at least a group with strong interest in financial history. So I look forward to more interaction. Thank you very much.
Thank you, Professor Lin, for the very detailed and wonderful comments. So Chenzi, we have plenty of time, so I think you may want to respond to Professor Lin's comment. You're welcome.
Thank you so much, Professor Lin, for your careful reading and all your comments and thoughts and suggestions. I really appreciate it. I appreciate your time on this. So you raised a lot of excellent points, and the first two or three that you were really talking about, I think, are the main ones that, to be perfectly honest, are kind of make it hard to write the paper, because it's a little hard to do this juggling act of how much you can claim to really, or we can claim to really nail a channel versus acknowledging that there are other things going on. I really like your idea of looking at whether trade financing becomes more common across places after getting access to a national bank. So, ideally, the data we would have wanted was more bilateral flows. So something that would have allowed us to say, hey, look, economic integration between two places that have national banks increases relative to places, the place that had one versus a place that didn't. And ultimately, we haven't been able to find anything bilateral, which is why we ended up going with these, like just output variables. And again, because of the nature of sort of historical data, there's a few sets of common data sources that we can rely on, like the Census of Agriculture and Manufacturing, which relates to what Scott Fulford has done. So yeah, so that's the contribution relative to that. We really do think is this emphasis on the liquidity provision channel, but yes, I think it's very much the case that I try to be upfront about it, but it's hard to observe, so it's hard to measure. But yeah, I think I think this question of the extent to which traded crops or certain types of crops could be used as collateral for direct access to financing, that's actually a really good point. And it's not one that I thought about before, but you can imagine that traded crops are more profitable, and profit allows you to basically invest in the sort of capital that you actually can use as collateral, right? So, or it allows you to pay off your mortgage.
Issue, right? So, I mean, like the farm, the land is, the liquidity must be low, right? But the traded crop is easy, right? So you can trade it on exchange or something somewhere else. So that's related.
Yeah, exactly. And I mean, that's exactly right. And it's actually something you might expect to happen. We are exactly saying that essentially the profits of the incentives, the profits for being active in the traded sector are going to go up. And so we should expect that to land somewhere and impact credit somehow. So I'm going to have to think a little bit more about how we could try to get at a sense, like try to measure that more clearly. But that's a really nice point. Yes, so this question about the granularity of the outcomes, that's work in progress. So what we're doing right now is geocoding all these locations, and then that will allow us to look at the towns around and see whether in fact treatment is either treatment is not as clear cut as we think, because there are places with national banks around. So like untreated, what we're calling untreated places actually have very clear neighbors. We're also going to look at spillovers in the outcomes. So and in particular, try to the extent that our sample allows it, to look at granularity in spillovers to places that have versus don't have national banks already. So again, we hope that we would expect to see that in this sort of more triple difference setting, that you would have bigger effects in places that don't. So yeah, so that's a great point about the using another threshold. So the 50K threshold is a little bit difficult because those are going to be super big cities that always are very financially developed. But in 1900 or 1902, actually, they introduced a new population cutoff for towns that are at the 2,000 population. So this was because they realized that for very small places, 50K was just, kind of unreasonable. So they actually introduced a new population cutoff that I haven't collected the data for, but that would be precisely something to do for these very small places. And this question of the population in 1880, why should we think of that as being unaffected by this legislation that was passed in 1864? I think we should be clearer about how we're dealing with, how we're thinking about that. So the legislation is written such that when you create a bank, the population that matters is the most recent census. So for ones that were created right after the the act passed, what mattered was the 1860 census, and then subsequently 70 and 80, etc. We try to deal with the fact that there is some differential growth that is capturing some sort of potential element, like potential growth with the change in population. But you're entirely right that there's no need to restrict that just to the 1870 census. And in fact, using the placebo population from earlier censuses and perhaps even the population change from 1860, those are all really nice robustness checks and sort of just understanding better what's going on that we can do. And yes, so we don't do a strict RD just because the density at the cutoff is, there's just not that much density at the cutoff, but we can definitely do better in terms of, or we can definitely do more in terms of, you know, showing it with a polynomial and all of those things. So yeah, I thank you for the range of comments from, you know, big picture to very, very executable checks. I really appreciate it.
Okay, thank you, Chenzi. Now let's turn to the audience question. Now we have received 4 questions from audience. The first one is about institutional background or historical background from Chin King Yang. Why don't the state bank form unions to accept notes from member banks? This gives them a great competitive advantage.
That's a great point. So the short answer is, well, you know, the banking sector after the national, the second national bank of the U.S. sort of, when it was dissolved, was incredibly unregulated. You know, this was a period that was known as wildcat banking. Milton Friedman wrote about it. There was a lot of opportunity in simply creating a bank, raising the equity, printing some notes, you know, living off the seigniorage for a bit and not actually doing any sort of legitimate banking business and closing your doors and having raised a nice bit of equity and basically, you know, taken advantage of the note holders. So I think banks were, so people were wary of banks and banks were very wary of each other. And what you do see, so actually this is a great point about this competitive advantage, is you do see a form of this sort of collaboration taking place among groups of banks. So you do get correspondence relationships and smaller bank networks where they're not officially taking each other's, where yes, where essentially they're, you know, it's almost like check clearing, where they're doing something where they're clearing accounts at the end of the day, and it's the idea is that they know each other well enough to essentially take each other's notes. But this is something that, you know, is happening on a very one-by-one basis, depending on the information available to these banks, and it was only really for the very reputable places. So so it's much harder for remote places, smaller places, and ultimately that's kind of the places that we think that we end up really focusing on.
Okay, thanks. So the next is from Ling Feng Li. Can you please comment on the credit creation in such a system of national banks without the Federal Reserve System, compared to the current banking system with a central bank? A related question is how much of demonstrated results in local economy is the result of banking transactions or that of credit creation?
Yeah, that's a really great question. So, you know, I think the national banking system and period is really interesting for helping to really understand the way the Federal Reserve System works now, because, what you see from the national banking system is that there was a very large aversion to a formal sort of regulation like the first and second banks of the United States. So, you know, something more akin to the European system with like the Bank of England, the Bank of France. This was something America was very hesitant about. And so the ways that you see the US system go closer and closer to the current Federal Reserve System is that eventually, when they created the Federal Reserve System with the 12 regional banks and stuff, the note issuance was still fragmented. So it was still the case. So with the Federal Reserve System, they got rid of having individual banks print notes for the money supply. What they replaced that with was the 12 regional banks of the Federal Reserve System could now print the money supply. And so, you know, you have banknotes from the Federal Reserve Bank of Chicago and New York and all of this. And it was only, I think, like at least a decade or two later that they eventually subsumed it with one Federal Reserve Bank note. But the concept that banknotes should be backed by treasury bonds, which is the way it works in the Federal Reserve these days, was created during the National Banking Act. So essentially it was, you know, the system became more and more centralized over time, but it really went in baby steps of, you know, going from individual banks who could decide what they wanted to do. This was very important to bank regulators. They were very afraid of having large banking conglomerates, to this more regional system where, you know, the different regions of the US could share power and nobody could be too dominant, to finally the system that we have today, where basically the board has most of the decision-making power in conjunction with the Fed of New York. Yeah, so your related question about the extent to which it's credit creation, that's a really great point, and it's a little hard to put a number on it. But one thing that you do see in the early stages, the early years of the national banking era, is that the number of state banks, so the alternative to national banks, declines dramatically. So you have a huge collapse in the state banking system. They don't all go away. And in fact, later there's a resurgence. This resurgence actually comes, the narrative is that it comes precisely because the national banks are so bad at serving certain sectors of the economy because of all their restrictions, that it became very profitable for these unregulated banks to start up again. But at least in the early decades, when you have this the shift between state banks to national banks, for a lot of places, you know, financial development doesn't grow overall. There's not more banks as far as, you know, you can measure in terms of capital. There's just a change in the type. So, but then again, you know, the ways in which they're lending is very different. So it is hard. But I would say that the payment system clearly improved significantly. And so even if, you know, we can't say that it's, you know, I can't put a number on the amount of credit creation. I can say that there's a certain part of the results that I think I'm very convinced come from the transactions.
Okay, good. Now the third question is from Yan Hu. Would it be possible to do some falsification tests and different thresholds of populations to say that the effect was not driven by different involutions of cities of different sizes?
Yeah, that's a great, thanks for asking that. So we do that falsification test at different 500 population thresholds from 4,000 to 8,000, and we see that 6,000 is really the place that it binds, and we can, I think, following up on Professor Lin's suggestions, do that for different years as well, and probably also for the 1900 cutoff. Thanks for that.
Well, the next is from Ross Connor. Is it possible to add the mode of transportation of goods or services to the mix to distinguish these 6K towns, river towns versus railroad towns, and or river or railroad towns? Actually, I have a similar concern about the effect of a railroad. To my knowledge, the U.S. experienced a mass construction or expansion of railroad system during the late 19th century, right? As shown in many economic historians, including David Donaldson's work. So I guess you have controlled for the railway system in your control variables, right? Or whether or not railway system also played a role in driving your results from trade to the manufacturing growth.
So you're entirely right that there is a huge change in the rail structure, the rail network. What we've done is we have controlled for the market access term from Donaldson and Hornbeck, which is sort of the reduced form way of capturing all the changes, or the concatenating together the transport costs from one place to all other possible locations. And we, first of all, we find that these are treated versus our control places. They're incredibly balanced on these market access and railroad access measures. So it's a little hard for, I think, just empirically for that to generate too much of an effect. We do, so then when we control for it, it doesn't have much of an effect, and the railroad term is not very correlated as you would expect. We don't look at heterogeneity, however, and that might be something very much that might be worth looking into, to the extent that there is, even among treated places, there's variation in the change in market access. We might expect to see larger versus smaller effects. So that's not something we've looked into, but can definitely do that. In terms of the specific question from Ross, so the railroads data, as Professor Ma referenced, is pretty easy to use because of pre-existing work. And I think we could try to break that down into river versus, river, canal, sea versus railroads. And that's something we can look into, but it's a little bit higher cost. So we haven't done that yet.
Yeah, Ross Connor just followed up this question, saying that some towns begin or grow when the two railroads cross each other. Okay, so the question is whether or not the national banks more likely to be located there around the cross, I guess, based on your research. There's also the area canal that fostered many towns along or near its route. Yeah, so.
Right. Okay. That's so this question of the crossings, that's not something we have a nice measure of. We have measures of like the number of railroads that go through a town, that are like in the vicinity, and we have this market access term, but the number can be parallel tracks or however you want to configure it. So I'll have to think a bit more about that. But actually, I hadn't thought about this this physical crossing before. So that's something we can look into.
Okay, thanks. Now let's answer the last question from audience. Before we turn to Professor Chen, I think he's waiting for us asking some questions.
Oh.
So the last question from audience from Zhang Jiayu, sorry, it's not very clear. What's the difference between the two kinds of exchange rates? One, it's the exchange rate within the United States before national banks. And the second is the exchange rate among all countries we use today. It seems that the exchange rate within the US can bring much larger financial friction.
Yeah, you know, originally when we were thinking about this paper, we really did think of it as the impact of the introduction of a monetary union. And I think that's still a reasonable way to look at it, because we're going from a system with lots of little units that all have their own currencies that are that have an exchange rate with each other that varies over time, very similar to what you would expect with countries. There are also some differences, though. Ultimately, this exchange rate among these banks in the US is coming from precisely the perceived risk and physical transportation costs of taking a note from a place where it's not worth anything to a place where it could be worth something. And so that's a fairly clear function for how the exchange rate is determined, and I think it's fairly intuitive. Exchange rates across the world, you know, that's more complicated, and I think that there are certainly models for how exchange rates move and why they move in certain ways, but they are incredibly difficult to predict. Whereas here, I think you can reasonably say, if there's a change in the solvency risk of a bank, the exchange rate will move systematically in a certain direction. And internationally, you know, yeah, you have to think about the flow of goods and financial flows as well. And yeah, and I think it's not as straightforward.
Okay, thank you so much, Chenzi. We are running out of time. Let's leave some time to Professor Chen.
Okay, thank you, Chen. Chenzi, thank you very much for an interesting presentation. I just wonder whether you can actually do some counterfactual analysis, in the sense that I noticed you showed that the local banks contributed to local innovations. But from the 19th century to now, financial markets, or in general, capital markets, have become much more specialized. Instead of just relying on local banks acting as loan providers and also risk capital providers, now they are specialized venture capital funds and private equity funds, angel funds and angel investor funds, and so on. So I guess that kind of concentration of risk capital provision in a few areas, like you know, the Silicon Valley area and so on. So that has made you know, the concentration, the geographical concentration of risk capital provision has led to the concentration of innovation in a few places in the US. So that is at the expense of the many hundreds or even thousands of small towns, all contributing to innovative efforts across the US. So that kind of welfare loss, or I don't know whether this, I mean, this geographical concentration of innovation as a result of the geographical concentration of risk capital provision has made this society overall are better off or somewhat worse off, especially given that now there's so much, Trump support across the small towns. So that may have been partly a result of the over-concentration of risk capital provision in just a few places across the US, as opposed to the widely available banking capital that was at least partly acting as risk capital back in the 19th century.
That's a really interesting point. I think the lead article, the JFE this month is about precisely like local innovation and and so that would be a really interesting direction to go into. I'm gonna and this idea that there are persistent effects from what's happening early on. I would love to look into that more. So thank you for that question.
Yeah, thank you.
Okay, thank you all. Thank you, Chenzi, again for your fascinating presentations. Thank you, Professor Chen Lin, for your wonderful discussion, and also the questions from audience from Professor Chen. So in the end, let me announce the seminar for next week. Next Thursday, September 9th, we will invite Professor Max Haoyu from Peking University to talk about his serial research on the economics of fiscal reform in the Qing Dynasty of China. So welcome to join this event next week. We look forward to seeing you again. So thank you, Chenzi. Thank you, all the participants. Bye.
Thank you, everyone. Thank you so much.